Good morning, Kenna Tortoise Capital with a daily coaching lesson for our journeyman traders. This looks at a 3-day chart on symbol PBW, the clean energy portfolio. That is now a staple of our monthly asset allocation portfolio. Where that started to outperform the S&P and when it would come to our attention would typically be in and around this blue circle, where the price has now exceeded the relative performance of the S&P reflected by that thin red line. So this is about where the outperformance occurs, and that's what gets it into our portfolio at around a price of 25. It's up around 32 and a half right now. The yellow dots are opportunities to add to positions if you are a tactical trader. But I also want to show you the power of adding a little bit of technical analysis to this strategy, because PBW is on our radar screen all the time as an asset. And for a long time, it was in a sideways chop, underperforming the S&P, and then a harsh sell-off when the Trump administration entered the building. There were key opportunities to get out of that thing if you were in it, such as when the RL10 crossed the RL90, when the collapsing dragon occurred here in the RL30 crossed the RL90. I want you to notice on this little dead cat bounce that the PSAR, which is calculated with a price value of the RL10 on a 3-day chart, which is the equivalent of the RL30 on a daily chart, that's a pro tip. Kept you in that short position or kept you from chasing it. After the RL10 reverses after the harsh sell-off, you get an RL10 crossing the RL30, that's a P1. You get a standard supported spring crossing entry when it passes through the PSAR -1. You could also play it when price crosses the RL90, which is the strength of the trend of the next higher time frame. You can see that that's starting to improve. This is where that slope of the RL90 actually gets stronger when the RL30 crosses the RL90. So a typical entry for us on a supported spring crossing, guided by a stop in the PSAR, which has never gotten out of the position, would have been an entry around 17 with a $3 risk. So that's holding plus 17. That's about a 5-hour trade just from the first position. Now, our advice about keep 70% of your maximum favorable excursion would put a stop loss on that position at approximately here around 29. When you have that much of a gain, you might be well advised to keep 80%, which would be the blue line, which is interesting because that's 10% from the highest high while in the trade. And that's where the BMR uh, stop loss would be. This one would be under the 3-bar low, so keeping almost 90%. And then depending on how many of these you may have taken or not, your mileage may vary if you're wanting to keep a percentage of your max favorable excursion. I would note that this particular location here, that little harsh sell-off would typically trigger a swing trade exit, but because the PSAR would have held, a re-entry around the yellow dot or even sooner on a 1, 2, 3 entry would put us back in the position and allow us to continue to add to those positions. So that's a quick look at how some tactical technical indicators might give you some additional insights on how to add a turbocharge to your blended monthly rebalancing portfolio. This is a strategy that works with prices after the close in the evenings because the 3-day bar slows things down, smooths things out. You're not chasing price intraday, but it will catch every major market turn and opportunity in the broad indexes. So, if you're interested in this, you should be checking out our over the shoulder coaching program, which is on sale through the end of the year when prices go up, or our active coaching if you want to fine tune it to your particular trading style and and interests. Thanks for your kind attention. This is Ken at Tortoise Capital praying for peace, and keep your risk measured and your powder dry.